So tight money policy. This is used when an economy is overheated. That means that Y is greater than Y star. So for a tight money policy, the government will sell bonds. Then the central bank will increase the reserve ratio, leading to a rise in leakages. And the discount rate will also rise, causing an overall effect in credit creation to fall. So this means that market supply will fall, interest rates will rise. When interest rates rise, saving is attractive and borrowing is expensive, so consumption falls. Then the marginal efficiency of capital needs to exceed interest rates, but since interest rates are higher, investments will also fall. There is no impact on government expenditure. And finally, net exports. Exports fall, imports rise. And this is because of hot capital inflow, which makes the demand for rupees higher, causing the price of rupee to increase. Currency appreciates, exports fall, imports rise. So the overall net exports effect will also fall. Then, if we take a look at the AE curve, consumption falls, investment falls, and net exports also fall. AE falls, and equilibrium income falls by AE times the multiplier. Let's take a final look at the transmission mechanism. This here is LP. This here is the supply for money, quantity for money, and on the vertical axis interest rates. Then marginal efficiency of capital, and interest rates over here. And then we have withdrawals, let me draw it a bit higher, and injections. So money supply will fall. So money supply falls. Let's call this MS1. Let's say if this was the previous interest rate. Interest rates rise. Interest rates rise. This leads to a fall in investment. Initially this was the investment level. So investments fall, let's call this I1. Investments fall, injections fall. So if this was the previous equilibrium national income, this is your new equilibrium national income. And finally, um, the limited. Now we've shown how the transmission mechanism works. Uh, the supply for money falls, you get a new higher interest rate. Because of that interest rates, investment falls. Investment falls, injections fall, and equilibrium income falls. But if equilibrium income falls, this will lead to a fall in the demand for money. And this will be because of a fall in the demand for transactionary demand for money, precautionary demand for money, and since interest rates have risen, the price for bonds have fallen, increasing the demand for bonds, which means that the speculative demand for money has fallen. So T, P, and S all have fallen, causing a fall in the liquidity preference curve. So what will happen is the liquidity preference curve will slightly shift inwards, and this will partially reduce the impact of the tight money policy. This means that interest rates will rise slightly. If they rise slightly, interest rates will fall slightly, causing a slight rise in investment. So this is the crowding out effect of the tight money policy, that the total impact of the rise in interest rates will be partially reduced by the fall in interest rates due to a fall in liquidity preference curve because of a fall in the transactionary, precautionary, and speculative demand for money. So in the next video, we'll talk about the advantages and disadvantages of monetary policy, and then we'll talk about the liquidity trap to wrap it all up.